So let's go back on over here and let's make a sales receipt. Let's do this. So we're going to say, let's say that we have just a sales receipt. So we'll say that we made a sale like at the cash register for customer one, generic customer one, once again. Adding that to the system, and I'll just keep the date, looks good. MUI B to the N, payment method, whatever, I'll just make it cash. And so, and then I'm just gonna put it directly into the checking account because the undeposited funds situation isn't what we're focused in on here. So I'll just say that goes directly into the checking account right now. So into the checking, and let's just make it we're gonna make it an inventory item. So we have to deal with the issue of inventory, tracking inventory on a perpetual inventory system using a subledger to track not only the dollar amount, but the units. So I'm gonna say inventory item one. Let's copy that. Roger out, copy that. And then it's gonna open up this thing. I'm gonna say it's gonna be an inventory item. And we will say that how many aren't on hand. Let's put 10 on hand. That will create a transaction for the purchase or increase of the inventory. And I'm going to say, put that on, at the beginning of the month. Let's say reorder point, let's just say is 0. Inventory account is the asset account that will go up when we purchase, down when we sell it. We're selling it here, so it's going to go down. It's going to go up by the 10 units, but then it's going to go down by the 1 unit that we sell here. The rate, we're going to sell them for, let's just say, good old $100. Income account that will be impacted when we make the sale, as we will here, is the sale of product income. And then the description, when we buy the inventory, we're going to say we buy them for, let's say, $70. And cost of goods sold will be the decrease. It'll decrease inventory when we sell it and record the expense account of cost of goods sold for the consumption of the inventory. So the net impact on net income when we sell it is going to be 100 minus 70. All right, let's save and close. And then we'll go, okay, so we had 10 on hand now because we just put the 10 on hand, which recorded a transaction. And we're going to say $100 tax is applied. So $8 tax. What's this going to do? Well, it's a sales receipt. So instead of accounts receivable going up, it's going to be increasing, in our case, the checking account instead of undeposited funds. And then the other side is going to go, and that's for the full amount, including the sales tax, which it's populating here, but for some reason it's not calculating until I record it. It's a little bit glitchy. Again, I think the sample company file is a little more glitchy than the QuickBooks file. So I'll record it and then I'll go back into it. And that sales tax should be calculating to $108 that we're going to be collecting. The other side then is going to be going to sales, which is $100. And then the difference of $8 is going to go into the sales tax payable, a liability account. And then we're going to have a decrease in inventory of the, what did we say, $70 driven by this item. And then cost of goods sold will increase $70. Net impact on net income, 100 minus cost of goods sold of 70 for $30 net impact. And the subledger will be impacted not only by dollar a unit, but by units of inventory. Okay. So let's save it and close it. I did that quick because I know we've seen it before. So I'm going to go back into the sales tab just to check out to make sure it populated properly the invoice after we recorded it. Let's go into the customers here and go into customer numero uno. That's number 1 for non-Spanish speakers. I've been learning Spanish with the YouTubes. The YouTubes got the subtitles. So there's 108. So if I go into that, we go into that. I used to try to learn with Star Wars, but then Star Wars went crazy. And so I have to watch other things that aren't lame these days. Anyway, so then I'm going to go then to I really like Disney Plus has a good language dubbing, but everything else is, okay, anyways, you're getting off track. Let's go to the tab to the right. We're going to run this thing. And then we're going to go into the checking account. The class is trying to distract me here again. Oh, it's trying to distract me, get me off topic. We're doing accountant here, accountant things. So we have the sales receipt. So there's the sales receipt. There's the 108 for the full amount, including the sales tax. Let's go back. Let's go to the tab to the right, run it again. on the income statement. There's the $100. Let's go back to the tab to the left. The other side, the $8 is going into the Board of Equalization, which is basically sales tax payable. Sales tax payable, there's the $8. Let's go back up. And then then we also have inventory is going down. So here's the inventory. Let's go into that. Now we put the inventory on the books because we said we had 10 units of inventory. So we put the inventory on the books and then we sold one of them for $70, increasing the inventory or decreasing the inventory. And then on the income statement, we scroll down, there's the $70 in the cost of goods sold. Let's also take a look at the subledger for inventory. I'm going to right click on this tab up top to duplicate it. So I have another tab for the subledger of inventory, going then to the reports on the left-hand side. And we're going to say this is going to be the inventory valuation summary. There it is. So now let's just bring this up a few days just to make sure I have this covered. Close up the ham boogie. And so now we put 10 units on the books. We sold one of them. So we're down to 9 units of inventory. The dollar amount of inventory is currently at $1,226.25, which should tie out to what's on the balance sheet on inventory, $1,226.25.